So thank you all for coming, and thank you for coming to listen to my presentation. And I'm looking forward to share some of my ideas, but also listen to some of your insights and see how you think as well, and exchange some ideas this way. And if at any point I say something a little unclear or in English, maybe it might be helpful if I translated Chinese, just let me know. Or if, and I'll do my best. My Chinese isn't that great. And also, my topic of presentation is going to be 8 ideas to make money, because the big goal of finance, I think the big question they ask is, how do we make money? And it asks that question in 100 different ways, but it's all the same question, the same end question in the end. So at the end of each idea, which I'll present, I'll also ask if any of you have any questions about it, and to see if we can exchange ideas or if it makes sense to you. So first of all, I guess maybe you already know a little bit about me, but I just want to do a quick introduction of some of my relevant experiences which can share. So first of all, my first entered the finance field, I think, my junior year as an internship. I entered at BlackRock. That's the Chinese name for the company right over there. And I worked in a hedge fund over the summer, which was a quantitative hedge fund where we used statistical signals to try to pick stocks and different debt securities. After that, when I graduated full-time, I actually worked at Cornerstone Research for 2 years. So that is a consulting firm, a financial and economic consulting firm, where lawyers understand the legal side of different cases very well, but they need an expert, usually a professor actually, to come in and explain the economic side. And we help support the professors, and we consult for them, and we consult for the law firms to help support the professors in providing that testimony. And so I learned a lot about how different fields intersect from my work here in finance and consulting. And then my academic background to talk about finance is that I had a master's in finance concurrent with my undergraduate degree. And I also, my main focus in my financial research was momentum investing, so different momentum investing strategies. And for the people who are new to this, momentum investing is just the idea in physics of momentum is that an object in motion stays in motion in the same direction. So stocks that have gone up in the past, the idea is that they'll continue to go up. And stocks that have gone down in the past, maybe like year, will continue to go down over the next year. And that's a phenomenon that we can take advantage of as investors. So I've split the presentation and my ideas into a few different sections to cater to the different audience. Unfortunately, I chose the ordering a bit poor because this one was more for the graduate students, different career advice from my own perspective based on my experiences in finance and consulting. But I think that in general, maybe this is something I can ask you about too. In general, it's about, my career advice would be that you have to learn both a general skill, a more generalizable skill, as well as a deep industry skill. And you kind of combine that skill and that industry knowledge in order to build a successful career. So my first idea is to learn computer science. Now, this is a very general idea, I understand. I think that the 3 main fields that are very generalizable across all industries are finance, statistics, and computer science. And every single industry increasingly needs one of these 3 things and can benefit from them. Now, why computer science specifically? It's because every single industry is trending towards big data, more and more data, and uses computer science more and more. For example, in the US, Goldman Sachs, it's one of the largest financial firm in the world. Their CEO said that he considers Goldman Sachs to be a technology company, not a finance company. At BlackRock, during my internship class, we are the biggest asset management company in the world. But we hired far more computer science interns and far more computer science full-time employees than we hired finance interns and finance employees. At Cornerstone Research as well, we are increasingly looking at how we can use machine learning to help support our experts. And we're looking for different professors who also have that combined economic and potentially computer science background. So we can see that both in finance and consulting, there's this trend towards more and more computer science and how it can play a part in our jobs. Even in academia and research, I think the best example of this is Susan Athey from the Stanford Graduate School of Business recently published a few papers about how she's trying to merge econometrics and machine learning and seeing how we can get the best of both worlds. And she published a paper recently about machine learning methods that every single economist should know. And so it's a often given advice, but I think there's a lot of evidence to support that in finance and consulting, we're trending towards using computer science more and more. So that's my first point on a general skill to build. Did anyone have any questions about it or about any of the examples I brought up? If not, I'll move on quickly to the next one. So the next one is understand contentious industries. Now, what do I mean by contentious? I think contentious or declining. And this is counterintuitive at first because contentious just means there's a lot of arguments. There's a lot of conflict in the industry. And that often, and declining industries, they're going downhill over the long run. So usually they don't attract a lot of study. But the thing about contentious industries and declining industries is that they often need a lot of consultants. Okay, so contentious industries, let me give some examples. Healthcare attracts a lot of lawsuits. Automobile companies attract a lot of lawsuits. And when they're sued, there's not one lawsuit, not just one class action lawsuit. First, the California government will sue them. Then every other state. So 50 lawsuits from each of the 50 United States. Then every single county will now sue them. And now the federal government will now sue them. Now foreign governments will start to sue them as well. So there are a lot of lawsuits and they need a lot of help. They need help in understanding the economics and the statistics behind how their product has impacted consumers, for example. And being an expert in this industry and what do I mean by being an expert? Often it means maybe if you have industry experience already, that's perfect. If you don't, maybe publishing a paper related to it, having a book where you use it, where you reference that industry heavily as an example. That gives you an edge to become a consultant for industries that very much need them. Also, there's a different type of consultant. I'm talking more about the economic consultants. There are also management consultants. For example, McKinsey, BCG, Bain. And and this is more for graduate students, but they often do hire PhDs. But when they hire a PhD, they want that PhD to already have some deep industry knowledge so that they can focus on one industry and one type of business problem. And understanding contentious industries where there's less competition will give you that competitive edge in getting a job in management consulting. So that's my view on, this is some surface level career advice from my experiences, from my work experiences. Any questions so far? No, okay. So I'm going to move to potentially more interesting for you. Investment advice. So I have to say, first of all, a disclaimer that I started investing quite early in stocks. I started investing maybe when I was 12, but I don't have, and I also learned it more quantitatively from my schoolwork, my master's in finance, and also my work experiences. But I won't say that I have as comprehensive or complete an understanding as some of you. So please bear with me if that's true. First of all, I think just avoid long-term losers. That's one of my tips. And I think it's a tip that very few people take, actually. So first of all, I'll just explain industries that are highly profitable now but are going to decline at some point in the long-term future. We don't really know when. I strongly suggest you avoid investing in them. And often these industries have cyclical periods where they're very richly valued. And I'm talking about tobacco, I'm talking about oil and gas, I'm talking about some past examples, coal, textiles. So they're industries that people are willing to invest in them because they don't see a catalyst. We know that they're going downhill maybe in the next 50 years, but we don't have a catalyst over the next, we don't see, neither we nor stock analysts see a catalyst that will cause it to decline. And so we kind of rest assured that we will always be able to, even if we buy it at a high price, we'll be able to reset it at a higher price when their earnings are very strong next quarter, for example. But I just want to give a few examples kind of to counteract that. Because the idea is even without a visible catalyst that will bring the stock price down to its intrinsic value, just the fact that if you keep a long-term horizon, which is very difficult for investors nowadays, but if you keep a long-term horizon, you don't need a catalyst. The stock price will approach its intrinsic value from one lucky event or another. That's the trend that's to which it'll go. So here are some examples. So a recent one, tobacco. Altria, the largest tobacco company in the world. In 2017, it was $77. As of now, it is dropped to $50. Okay, so why is that? It became richly valued because because people saw a lot of positive cyclical trends in tobacco. For example, Donald Trump elected in 2016, and he seemed to be very friendly to businesses. And he appointed Mr. Scott Gottlieb to be head of the FDA. Unfortunately, last year, Mr. Scott Gottlieb, the FDA administrator, he wrote a personal letter where he said that he had seen the negative impact of tobacco on adolescents all around him, including kids near his age. And he said that I am very much against tobacco. I'm very much against tobacco addicting people. And that along with some other comments. Now, he's retired as the administrator, and we have a new one. But the new administrator is not any more friendly towards tobacco either. So even when things seem to work out in their favor in the short run, the long run truth is that these industries are in decline. Let's talk about coal. Coal went from $21 in 2013, and as of now, it is 4 cents. The top 10 coal production companies as of 2014, 6 of them have gone bankrupt. Even the greatest investor in the world, Warren Buffett, or one of the greatest investors, Warren Buffett, he bought Berkshire Hathaway, which is a textile company. But he was not, now it's converted completely to an investment company. But at the time he bought Berkshire Hathaway, he thought that it was a deep value play. He was not able to save it. So when the greatest investor in the world and one of the greatest business managers in the world cannot reverse an industry trend, it's the lesson to take away is that you shouldn't work against the trends, the long-term trends. You should work with them instead, or potentially avoid them when they're declining. Now, does anyone have any questions about this? I'm going to talk a little bit about the current investment climate as I see it, based on my work in the field. Maybe 20 years ago, we were very focused on return. Investors were very focused on getting the best return possible for them, the best average return. But from my perspective, I think we are focusing more and more on risk, on mathematical hedging, various risk factors. We've learned about beta. We've learned about the Fama French has popularized several risk factors as well. BlackRock, the biggest new product out of BlackRock is called Aladdin. It's a risk management platform. That's essentially what it is. It uses machine learning to predict for example, one of its main features is if you give it a current event, like, for example, one of the events we used as hypothetically was if Donald Trump is elected, what happens to the Taiwan stock market? What happens to the Europe stock market? And it's all about predicting potential occurrences and how risk and the potential risks that emerge. So we are, in the last 10 years, we have become increasingly risk-focused. My work assignment at BlackRock as well, as an intern, I worked at a hedge fund where we used different statistical signals to invest in stocks. And my whole summer, my assignment was to make a platform to monitor that risk over time, to monitor the different correlations between the different signals, to monitor how return correlation over time and holding correlation was shifting. And so we can see that BlackRock and the finance has kind of shifted towards a very risk-focused perspective. Cornerstone too, Cornerstone Economic Consulting, we've also kind of taken on some of that risk perspective because that's what our clients are focused on. For example, for securities cases, which is when securities cases are when the stock goes down and stockholders sue management for mismanagement, for example. Our first task is to evaluate the potential range of damages with a maximum and minimum, a very plaintiff-friendly style and a potentially a defendant-friendly style as well. So you can see that in consulting, in finance, in economics, we are focusing more and more on risk. Now, is there a way to make money off this? I think there probably is. Like many different startups are now focused on measuring risks. My small suggestion is that we can make a website and that takes a portfolio of stocks from investors and then suggests the industry ETFs that have the lowest correlation with them, the best hedger ETF. So that's just a small suggestion, and there's many more ideas from much smarter people on how to take advantage of this trend towards risk avoidance. So I'm going to move on to the next point. Oh, please.
Yeah. I'm just wondering, in your talk today, are you going to talk about the social aspect related to all the topics you're talking today? Because so far I've been hearing one thing, which is only the richer people are going to get richer. Because computer science, also the BlackRock and everything, right? They require a lot of machine learning, so they require a lot of resources, right?
Right.
Under this
like
kind of structure today, less privileged people in terms of a finance perspective or intellectual perspective, they'll become very disadvantaged in the future. Especially like when you talk about momentum investment, kind of a little bit against what you just talked about in terms of a long-term perspective, right? Because when you talk about long-term perspective, actually it's really against what you're talking about so far, because the hedge fund, because like trading by minutes, by seconds, things like that require a lot of hardware, software, and smart people to work on that.
Right.
And less privileged people won't be able to do that.
Right.
Right. A lot of people saying this is for the rich people only. So that's what the movement in Wall Street a couple of years ago was really about.
Like Occupy Wall Street, for example.
Yeah, Occupy Wall Street.
In America.
That's what really about. So, and also things like what you're talking about so far, like number 4, it's actually in essence the same thing, right? So I'm just curious about the social aspect of what you've been talking about, because the world, of course, is driven by finance. It's a blood of this world, right? Because of the capitalist world. Right. So I'm very curious because although I'm in BA, right, business administration, I understand what this is really talking about. It's all about the bottom line. It's always about growth. It's always about this and that. Right. So what do you think about in terms of social aspect of what you've been talking about so far?
Yeah, and definitely. And that's something I've thought about a lot myself, because I'm also, like you said, an individual investor. I do not have machine learning. I do not have a big server of computers to analyze tick data. I don't even have access to a lot of the data. And I think that the best thing for an individual to do, is to understand big trends like this and try to position themselves with their resources to take advantage of one of them and kind of ride one of them. Big companies, like you said, they can take advantage of a lot of different things. They can work on machine learning, they can exploit some of the tick data and do momentum investing. But I think there are still many more opportunities as well for individual investors to also improve their own financial well-being. And I think that's true for both individual investors with less resources and also more resources. Now, what you said about some of the points do seem a little to conflict. That's because I think there's a lot of different ways to make money. And sometimes some of them conflict with each other. Like momentum, I agree that it seems to, it's more of a short-term, medium-term perspective versus avoid the declining industries. But it's a different perspectives give you different ways to make money, and that's what makes finance a very rich field, because you could see it from a lot of different ways. And it's very helpful as well. Of course, big companies will always understand it and potentially have an advantage in the broad area, but if individual investors are willing to investigate a specific area very deeply, they actually might have an advantage over there. So, does that answer your question at all?
Kind of.
Okay. Well, we can discuss it more later.
Sure.
Okay. Yeah. So the next one actually relates to this a little bit. I think there's, and this is my perspective, and I might not have a complete picture, but I think there's a renewed need for active management for the individual investor and also professional investors to look more deeply into stocks from a fundamental perspective and a financial perspective. And why is that? Now, it's because there are more, the big money flows in the stock market nowadays are ETFs and computer-driven algorithms from big financial firms and hedge funds. And that accounts for a great majority of the volume in our everyday market. What does that mean, though? And it's also, the trend has always been, for the last 20, 30 years, against actively managed funds where we have a professional investor who looks into different stocks and try to uncover opportunities. It's been, while active investment has declined, passive management has actually been on the rise. Passive management has been on the rise where you invest and it's just an automatically split your money into the 500 S&P stocks or automatically split your money into the industry. Now, they weight it by market cap. So ETFs are inherently momentum and inherently you buy the expensive stocks that have gone up a lot and you buy less of the cheaper stocks that have gone down a lot. My hypothesis is that these two trends have led to a renewed need for active management, where active management becomes more and more profitable. Because active management, where you uncover stock opportunities, it stops working when there's too many active managers. There is a limited number of value opportunities in the stock market. And when it's split between a lot of different managers, those managers end up not capturing very much return individually. As the number of active managers has decreased, as momentum gets expensive stocks to become more expensive, cheaper stocks to become even more cheap because of their weighting, then active management, the role of active management in correcting pricing differences emerges again. And now, how do we address the computer-driven algorithmic trading? Well, they're different. They don't conflict very much because computer-driven algorithmic trading is on the time horizon is the seconds or the milliseconds even. And some of the longer term ones are, for example, at my hedge fund, the hedge fund I worked at, the time horizon was more a few weeks or a few months at most. But active managers can sometimes have a few years perspective or maybe a few decades even. A long-term trend that they've captured that they feel like they understand deeply and they're willing to invest both their money and their time in. And that has declined over time, but it seems to be, at least, the trends seem to suggest that it will be on the rise again in the future. Does anyone have any questions about this?
So what you're talking about, there are different kind of investing, almost like philosophy.
Exactly, yes.
For different kind of position.
Mm-hmm.
Especially from aspect of time horizon.
Yes.
So this is very, very short term in nanosecond or something like that.
Yes, computer-driven ones.
Thank you.
Yes. And then when the active management I'm talking about is more on the years time horizon. That having a different time horizon from everyone else gives you a competitive advantage because there are few people competing with you over the profits you can make from a long-term time horizon. So that covers some of my points on more traditional investment management. And now I'm going to talk a little bit about quantitative finance. This might be, there might be more questions, and it's more about the statistical side. Especially in my undergraduate, I researched momentum investing, which is, like I said, the principle of buying stocks that have gone up and then maybe potentially selling short stocks that have gone down in the past. So a lot of my insights might be from a momentum investing perspective, but hopefully they're able to generalize to the other quantitative financial signals that people have uncovered. So just a quick background on quantitative finance for people who are less initiated. Quantitative finance and statistical finance is basically the idea is that you have this anomaly, a statistical anomaly, where certain stocks, based on past behavior and past easily quantifiable metrics, you're able to determine that this stock will go up or down more in the future. And then you backtest that hypothesis over maybe like 100 years of data, and then you calculate the statistical significance of the difference. And it's always a cross-sectional difference. So you calculate a score for every stock, and you buy the stocks with the high score, and then you sell short the stock with the low score, and then you calculate the difference in return between the high score ones and the low score ones. Over 100 years, you test if that difference is statistically significant or not, and if it's something that you can exploit in today's market as well. So my very first point is going to pretty directly touch on momentum, and it's going to talk about acceleration. So if from physics you know that momentum is just objects in motion will stay in motion, it will maintain its momentum. Acceleration is potentially, we think that stocks that are accelerating upwards will do even better. Because if it's only steadily rising and it's already improving, I mean, it's already very profitable to invest in past winners. Shouldn't it be even more profitable to invest in stocks that are accelerating upwards? But recent studies have shown, Shong and Ibatsen in 2015 showed it's actually the reverse is true. Stocks that are accelerating upwards reverse very quickly. Stocks that are accelerating downwards have an opposite reversal. They perform very strongly, in fact. And I think the business lesson from this is that we want to have more steady growth, more like 10% growth every single year, as opposed to trying to accelerate your growth, 5%, 15%, 35%. Because acceleration is just not sustainable. From physics perspective as well, acceleration requires constant force to maintain it. Versus momentum, which can be maintained with very little effort. From a business perspective, that might be, the acceleration might lead to your downfall because it's impossible to keep accelerating because of working capital constraints from growing too quickly, because you're not able to scale your employees as quickly as you can scale your franchises. There's a lot of different reasons, but I thought it was very curious, and I wanted to share this fact that if you see a stock accelerating upwards, it's probably a bubble. And that's what bubbles look like, and that's what you do not want to invest in. On the other hand, things are accelerating downwards, that might present a value play. And in fact, Shonen and Batson showed that on an analyzed return, the stocks that have accelerated negatively the most, so the bottom quartile, they had an annualized, I think 12% return the following month. So very strong investment return. Any questions on this? No. Okay. So next one, I'm going to keep a secret. Once you, a lot of people are very eager to share their investment ideas, but I know from BlackRock that we monitor academic and financial journals very, very closely. We are always scouring them for ideas. Even working papers are not safe. And this phenomenon has actually been studied by academic journals already. So we have an academic study that shows that once you publish an academic study, publicizing a financial anomaly or a way to make money for a hedge fund, the effect disappears within a few months. So we now know that practitioners are constantly looking at what the research that academics are putting out, and they are also taking advantage of it. And often, after they take advantage of your idea, they will invite you in to give a speech and talk further about it, and if they have any questions. So my suggestion is to keep it. If you really find a useful idea that you yourself can take advantage of, I think you should keep it a secret and use it for yourself. Even if you're interested in working in the financial industry, in a hedge fund, for example, it's still very valuable to keep it a secret. The structure of hedge funds, you think they're very, I think in the public view, it's very black box. But the actual structure of hedge fund is there's a corporate side and a manager and a salesperson, and there are a bunch of individual contributors. A bunch of individual contributors who all have their own signals as part of their toolkit. And that is what makes them valuable to the company and valuable to the hedge fund. The fact that they have their secret in their head and that can help the hedge fund make money, and other hedge funds do not know about it. So if you're able to keep it in your head and keep it as part of your own toolkit, you'll not only be able to profit from it yourself, but you'll also become a more valuable contributor to different hedge funds. So yeah, hedge funds are very much a mix of individual contributors, in addition to like the corporate side, who is setting the hedge fund to their different clients and managing those relationships. But it's a lot of different individual contributors who all have their own ideas and are contributing to the hedge fund for now until they move on to their next employer. Any questions about this or about quantitative hedge funds in general? No. Okay. Do we all understand? Okay, great. So, yeah. All right, I'm going to move on to my last one. So, and then I can take any like collective questions like now at the end. So this one is geared exclusively for individual investors. Take on one side of the rule. So statistical anomalies are very mathematical. Quantitative finance is the intersection of statistics and math and finance. And so we have some aspects that are very finance heavy, but some aspects of the culture are very math heavy. For example, statistical anomalies are all cross-sectional, as in we can apply a score, a percentile score usually, to every single stock in the universe. And BlackRock as well, our signals are always applied cross-sectionally in order to look at every single stock in the universe. And the mathematical idea is that the more you apply your rule, you have a rule about how stock prices perform. The more you're able to apply it, and the more context you're able to apply it, the better. Because if your rule is correct, then the more statistically sound it is to apply it in as many places as possible. But as individual investors, we do not need to care about this theoretical nuance, and it's very mathematically elegant that this rule applies equally well to every single stock. But individual investors don't need to be too concerned about this mathematical elegance. And I'm going to give an example about this, about how sometimes you can apply the rule to some stocks and then purposely not apply the rule to other stocks. Momentum investing. So this is my own research. Momentum investing has done very, very well over the last, maybe not the last 5 years, but before that, the last 90 years. They've done very, very well. And, but there are 3 times in history where momentum has done not very well. It's done very poorly, not a few months return of not negative 30% or negative 50% even. It's more like negative 150%. So you lose all your money and then half of what you had invested. And the reason why is because you're not only investing in winners, you're also setting short. You're borrowing someone else's stock and you're selling it. You're setting short the loser. And the loser sometimes, 3 times in US history, stock market history, has crashed upwards, losing you all of your money. Losers, and for example, in 1932 or 1933, our president of the United States at that time, Franklin Delano Roosevelt, he unveiled a government plan to bail out banks. So banks that had been on the verge of bankruptcy all of a sudden doubled and tripled overnight on their stock market prices, and their value doubled. And that, because they had done so poorly in the past and a momentum strategy had sold those stocks short, momentum underperformed drastically. So how do we counteract that? How do we decrease volatility in momentum and use it for our own purposes? And the easy way is to just buy only the momentum winners and don't worry too much about the losers, because losers sometimes reverse drastically, right? But winners are often, they're not as exciting and they don't earn you as much money, but they're much more stable, they're much less risky. And it's a much more safe investment for an individual to make, to buy stocks as opposed to setting short. And there are other examples too. You can apply the rule, maybe you can apply rules that used to work in the US in less developed stock market. Or you can take some rules that work for different industries and then see which industry it works the best in the financial industry, in the basic materials industry, in the retail industry. There's a lot of different ways you can focus your attention. And then because you're more focused, you understand the industry at a deeper level, you're less liable to fall for the pitfalls when the signals occasionally don't catch a pitfall that you might fall into. So you're able to understand it more deeply, and you're able to combine your statistical knowledge or this momentum rule, for example, with your own industry experience. And so that is my last way to my quantitative finance idea, and that's my 8th way to make some money. So so thank you all for listening, and please let me know if there are any parts that I was unclear about or if you have any questions at all.